They told you it was just another rally. They told you China was stable. They told you the commodity markets were functioning normally, that the regulators had everything under control, that the premiums would correct themselves, and everything would settle down. And then, without warning, China pulled the plug. Not on one fund, not on two funds, on 5 commodity funds in a single trading session. The only silver futures fund in the entire country shut down for the full day. 4 oil funds frozen until further notice. And most people scrolling through their feeds had no idea it even happened. But here's what makes this different. This wasn't a routine pause. This wasn't a technical glitch. This was an emergency intervention designed to stop what regulators called systemic risk and potential massive investor losses. And when the second largest economy on the planet starts slamming the brakes on commodity trading because premiums have spiraled out of control, you don't get to pretend it doesn't matter, because it does. It matters for silver, it matters for gold, it matters for oil, and it matters for anyone holding hard assets in a world that's starting to question everything it was told about stability. Quick favor before we go any further. I'm building something real here at Financial Crux, and that means cutting through the noise that dominates most financial content. If you find value in what we do, support the mission by subscribing and dropping a comment below. And if you want the fast updates that don't always make it into full videos, join the WhatsApp community and follow us on X. Links are in the description. Let's get into this. I want to start by explaining exactly what happened, because the details matter, and most coverage has glossed over them completely. On January 30th, Chinese financial authorities implemented what can only be described as emergency trading suspensions across multiple commodity investment funds. The most significant of these was the UBS SDIC Silver Futures Fund. This is not just any silver fund. This is the only public fund in mainland China that directly invests in silver futures, the only one. When Chinese investors want exposure to silver through a regulated fund structure, this is their option. There is no plan B, and on that day, regulators suspended trading for the entire session. Not for an hour, not for a cooling off period, the whole day gone. But here's the part that should make you sit up. This was the second full day suspension in 8 days. The first happened on January 22nd. Whatever they thought they fixed the first time clearly didn't work. The problem came back, and it came back hard enough that they had to shut it down again. At the same time, 4 separate oil-focused listed open-ended funds got hit with coordinated suspensions. These were shorter, about an hour each, with trading frozen until 10:30 a.m. Beijing time. But the fact that they all got halted simultaneously tells you this wasn't about one fund having a bad day. This was systemic. This was coordinated. And this was designed to stop something that regulators believed was spiraling out of control. So what exactly was spiraling? The answer is premiums. Specifically, the gap between what investors were paying for fund shares and what the underlying assets were actually worth. Let me explain this in plain terms, because it's critical to understanding why this matters. When you buy shares in a commodity fund, you're theoretically paying for exposure to the underlying asset. In this case, silver futures contracts trading on the Shanghai Futures Exchange. The fund share price should roughly track the value of those contracts. That's how it's supposed to work. But when demand for the fund explodes faster than the fund can add underlying exposure, something breaks. The share price starts trading at a premium to the actual asset value. A small premium is normal. Markets have friction. But when that premium hits 36%, you're in a different universe entirely. That's what happened with the UBS SDIC Silver Futures Fund. Investors were paying 36% more than the actual silver futures were worth. They were so desperate to get silver exposure through this fund that they were willing to pay more than a third extra just to get in the door. Think about what that means. If the underlying silver futures stayed flat, those investors would be sitting on an immediate 36% loss if the premium normalized. They weren't buying silver. They were buying hype. They were buying momentum. They were buying the idea of silver exposure at any price. And regulators saw exactly where that was heading. They saw retail investors piling in at unsustainable premiums, chasing a rally that had already run hard, and they knew that when the music stopped, those investors would get crushed. So they stopped the music themselves. Now, some people will look at this and say, it's just China being China. Heavy-handed intervention, overreactive regulators, nothing to see here. But that interpretation misses the point entirely, because what's happening in China is not isolated. It's a symptom of something much bigger playing out across global commodity markets. And understanding that bigger picture is essential if you want to position yourself correctly for what comes next. Let me set the stage properly. Silver has been on an absolute tear. In the last 30 days alone, silver has surged 58%, not 5%, not 15%, 58%. We're talking about prices pushing toward 120 tiles an ounce, levels that would have seemed absurd just a year ago. Gold has been running hot too, up 22% and approaching $5,600 per ounce. Oil has broken through resistance with Brent crude hitting 5-month highs above $70 per barrel. This isn't random. This is a coordinated flight into hard assets driven by forces that most mainstream commentary refuses to connect. First, there's the rate environment. Markets have been whipsawing between expectations of aggressive central bank cuts and fears that higher for longer will persist. Every time traders price in easier money, the dollar softens, real yields compress, and precious metals catch a tailwind. Every time hawkish rhetoric returns, we get pullbacks. This back and forth has created extreme volatility, and that volatility is getting amplified through leveraged instruments like the funds China just suspended. Second, there's the geopolitical overlay, and this is where it gets serious. U.S. naval vessels positioning near Iranian waters, tensions escalating across multiple theaters, energy supply chains looking vulnerable. When traders start pricing conflict risk into oil, and when investors start hedging currency debasement through precious metals, you get the kind of demand surge that overwhelms normal market structures. Third, there's the structural supply issue that nobody wants to talk about. Silver isn't just a monetary metal, it's an industrial workhorse. Solar panels need silver. Electric vehicles need silver. 5G infrastructure needs silver. The green energy transition that every major government has committed to is fundamentally silver intensive. And supply has not kept pace with this structural demand growth. When you combine monetary demand, safe haven demand, and industrial demand all hitting the market at the same time, you get the kind of price action we've been seeing. And when that demand gets funneled through a single investment vehicle in a market of 1.44 billion people, you get 36% premiums and emergency trading halts. Now, I want to talk about what this reveals about the psychology of the market, because understanding that psychology is how you avoid getting caught on the wrong side. Chinese retail investors, according to Krup's analysis, tend to be trend following. They chase momentum. When silver starts moving, they pile in. When gold starts moving, they pile in harder. This isn't criticism, it's observation, and it's not unique to China. Retail investors everywhere have a tendency to chase performance, especially when social media amplifies the narrative and creates the fear of missing out. What makes China different is the concentration. When 1.4 billion people have essentially one option for silver futures exposure, and when that option starts trending on social media, the flows can become overwhelming. The fund can't create new units fast enough to meet demand. Premiums expand, and the higher the premium goes, the more the momentum traders see it as confirmation that silver is hot and pile in even harder. This is the feedback loop that regulators saw and decided to break. Not because they're against precious metals, not because they want to suppress prices, but because they understood that retail investors were walking into a trap. They were buying at premiums that made no mathematical sense, and when those premiums inevitably collapsed, the losses would be devastating. Here's an analogy that might help. Imagine a concert venue that holds 10,000 people. The show is sold out, but outside there are 50,000 people desperate to get in. Scalpers start selling tickets at 3 times face value. People are paying $300 for a $100 ticket because they don't want to miss the show. Now imagine the venue catches fire. Everyone rushes for the exits at the same time. The people who paid $300 don't just lose the show, they lose their money, and maybe more. That's what a 36% premium looks like in a volatile commodity fund. You're paying a massive markup to get exposure. And if conditions reverse, you're the one holding the bag, while smarter money already exited. The question becomes, what does this mean for the rest of us? Because China's trading halt didn't happen in isolation. It's connected to global flows, global pricing, and global sentiment. Here's what I'm watching. When Chinese retail investors get shut out of their only domestic silver futures fund, that demand doesn't disappear. It redirects. Some of it flows into physical silver, some of it flows into Hong Kong listed products, some of it flows into gold as an alternative, and some of it creates pressure on international markets as capital finds other pathways. We've already seen evidence of this. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has compressed to its lowest level since 2011. That compression is not happening because gold is falling. It's happening because silver is playing catch-up in a dramatic way. When the ratio gets this extreme, it historically signals that silver is moving from undervalued to fairly valued, and sometimes it overshoots into overvalued territory before correcting. At the same time, physical silver demand has been exploding. One major dealer reported a 158% increase in sales of 1 OZ silver coins in less than 4 months, a 550% increase in demand for 1 kilogram silver bars over the same period. Google searches for how to buy silver and buy silver online have spiked 250% in recent months. This is not niche interest. This is mass awakening. People are looking for ways to get exposure to precious metals outside the traditional financial system. And physical accumulation is one of the clearest expressions of that impulse. Now, here's where I need to be the skeptic for a second, because you need this voice in your ear. Yes, silver has momentum. Yes, the fundamentals look supportive. Yes, China's trading halt reveals genuine demand pressure. But markets that run this hard, this fast, are also prone to sharp corrections. The same volatility that creates 58% gains in a month can create 30% drawdowns in a week. Krupp has projected silver reaching $150 within 3 months. That's a bold call. And it might be right, but it's also the kind of projection that tends to appear near tops rather than bottoms. When major banks start publishing aggressive upside targets, it's often a sign that retail enthusiasm is peaking. I'm not saying sell everything. I'm not saying the rally is over. I'm saying be aware of where we are in the cycle. The easy money has been made. The obvious trade has been executed. What comes next requires more nuance, more patience, and more discipline. If you're already positioned in silver, this is probably a time to think about risk management rather than adding at extended prices. If you're not yet positioned, this is probably a time to wait for pullbacks rather than chasing momentum at 52-week highs. The people who build real wealth in these markets are the ones who buy fear and sell greed. Right now, there's a lot of greed in the silver market. That doesn't mean the bull run is over. It means the next phase will require more skill than the first phase. Let me pivot to the oil side of the story because it's connected in ways that matter. The 4 oil funds that China suspended were all hit simultaneously. That coordination tells you regulators were seeing the same premium expansion dynamic play out across energy commodities, not just precious metals. And the timing is critical. Brent crude broke above 70 per barrel for the first time in 5 months on the same day these suspensions happened. That breakout coincided with U.S. naval positioning near Iranian waters. The market was pricing geopolitical risk premium directly into energy prices, and Chinese investors were chasing that trade through oil-focused funds with the same momentum-chasing behavior they showed in silver. Here's the pattern I want you to see. When geopolitical tensions rise, commodity prices rise. When commodity prices rise, retail investors chase. When retail investors chase through concentrated fund structures, premiums expand. When premiums expand beyond sustainable levels, regulators intervene. And when regulators intervene, it creates a temporary cooling but doesn't address the underlying demand. That demand is still there. The geopolitical tensions are still there. The supply vulnerabilities are still there. The regulatory intervention is treating the symptom, not the cause. This is why I believe the oil story is far from over. If tensions continue to escalate, if supply disruptions materialize, if the dollar weakens as rate cuts materialize, oil has significant upside from current levels. And the same forces driving that oil story are the forces driving precious metals. They're all connected. Currency confidence, geopolitical instability, safe haven demand, industrial requirements, regulatory capacity to manage flows. It's one story being told across multiple asset classes. Now, I want to address the practical question that I know many of you are thinking. What do you actually do with this information? Let me give you a framework, because frameworks are more useful than predictions. First, recognize that China's trading halt is a signal, not an endpoint. It tells you that demand for commodity exposure has exceeded the infrastructure's capacity to handle it smoothly. That kind of demand doesn't disappear when you suspend trading. It redirects. It finds other outlets. It builds pressure that eventually gets released. Second, understand that premiums and discounts in fund structures are information. When a fund trades at a 36% premium, the market is telling you something about desperation levels and supply constraints. That information is valuable even if you never trade that specific fund. Third, differentiate between trading and accumulating. If you're trading short term, this is an environment that rewards patience and punishes chasing. Wait for pullbacks. Don't pay premium prices for exposure. You can get cheaper next week. If you're accumulating long-term, short-term volatility matters less, you're buying the Decadel long thesis about currency debasement, industrial demand, and hard asset repricing. In that framework, temporary suspensions in Chinese funds are noise, not signal. Fourth, pay attention to the physical market. When fund trading gets disrupted, physical metal becomes more attractive. The premiums dealers charge for physical silver and gold are also information. When those premiums expand, it tells you that the physical market is tightening. When they compress, it tells you supply is catching up with demand. Fifth, watch the gold-silver ratio. This metric has been one of the most reliable signals in the precious metals complex for decades. When it reaches extremes and starts to mean revert, the moves can be powerful. When we're in one of those reversion phases right now, whether it continues or reverses will tell you a lot about where we are in the cycle. Let me share something that I think captures the moment we're in. There's a phrase that traders use: the market can stay irrational longer than you can stay solvent. It's usually meant as a warning against fighting momentum. But there is a corollary that's equally important. Regulators can stay interventionist longer than you can stay patient. What we're seeing in China is the beginning of a pattern, not the end of it. When commodity markets get hot enough to threaten systemic stability, regulators will intervene. They'll suspend trading. They'll restrict new purchases. They'll implement cooling off periods. They'll do whatever they think is necessary to prevent retail investors from destroying themselves. That doesn't mean the underlying trend is wrong. It means the trend is strong enough to scare authorities. And when trends get that strong, they tend to have more room to run once the intervention pressure eases. The historical precedent for this is clear. Every major precious metals bull market has featured regulatory interventions along the way. The 1970s bull run in gold had multiple moments where authorities tried to cool the market. The 2000s run featured similar dynamics. Each time the interventions created temporary pauses, but didn't reverse the fundamental forces driving prices higher. I'm not saying history will repeat exactly. I'm saying the pattern of intervention during strong bull markets is normal, not exceptional. If you're using China's trading halt as a reason to panic out of positions, you might be misreading the signal. Now let me talk about what comes next, because that's what matters most. The immediate impact of China's suspensions will be continued volatility and redirected flows. Chinese investors who can't access their preferred fund will look for alternatives. Some will wait for trading to resume. Others will find other pathways. That search for alternatives creates ripple effects across global markets. The medium-term impact depends on whether the factors driving this rally persist or fade. If geopolitical tensions de-escalate, if the Fed turns more hawkish than expected, if industrial demand softens due to economic slowdown, then the rally could stall or reverse. But if tensions continue, if rate cuts materialize, if industrial demand stays strong, then we're likely in the early to middle innings of a much larger move. The long-term picture is what I find most compelling. The structural forces driving precious metals demand are not going away. Currency debasement concerns are not going away. Geopolitical uncertainty is not going away. Industrial demand for silver and green technologies is not going away. Central bank accumulation of gold is not going away. These are multi-year themes, not multi-week trades. And if you're positioned for the multi-year story, the day-to-day noise of regulatory interventions and volatility spikes becomes much easier to navigate. Here's my question for you, and I genuinely want to see this discussion in the comments. Do you think China's trading halt is a warning sign that the rally has gone too far? Or do you think it's confirmation that demand is so strong that even regulators can't contain it? There's no wrong answer, but your answer reveals how you're interpreting this moment, and that interpretation will shape your positioning. Drop your thoughts below. And if you've been navigating this silver and gold rally successfully, share what's worked for you. That kind of real-world feedback helps the entire community. Before I wrap up, let me remind you that the links to the WhatsApp community and X are in the description. If you want the fast updates on regulatory developments, price movements, and market-moving news, that's where you'll find them. And if you found value in this breakdown, subscribe and hit the notification bell so you don't miss the next update. One more thought on the bigger picture. What we're watching right now is a stress test of global commodity market infrastructure. The combination of geopolitical uncertainty, monetary policy confusion, and structural demand growth is pushing markets in ways they weren't designed to handle. China's response of suspending trading is one approach. Other jurisdictions may respond differently. But the underlying pressure is the same everywhere. And here's what that pressure tends to produce over time. It produces repricing. It produces revaluation. It produces a shift in how people think about what's valuable and what's risky. Paper assets that seemed safe start to feel fragile. Hard assets that seemed old-fashioned start to feel essential. That's not a prediction about next week. That's an observation about where we are in a multi-dead cycle. The people who recognize these cycle shifts early are the ones who build generational wealth. The people who dismiss them as noise are the ones who get left behind. I know which group I want to be in, and I suspect you do too. All right, that's everything for today. I'm going to leave you with a line that applies to this situation and to markets in general. When authorities intervene, they're telling you something important. They're telling you that the market has gotten strong enough to scare them. And when markets scare authorities, it's usually because something fundamental has shifted. Stay sharp, stay patient, and don't let the intervention noise steal your conviction. This is Financial Crux. I'll see you in the next